The Little Book of Common Sense Investing. Wall Street wants you confused. The more complicated investing seems, the more fees you pay. The more you trade, the more they profit. The more experts you hire, the less money you keep. John Bogle saw through this game. He spent 60 years proving one simple truth. You don't need to beat the market. You just need to own it. This is the Little Book of Common Sense Investing, and it might be the only investing book you ever need. The core insight. Here's Bogle's famous line. Don't look for the needle in the haystack, just buy the haystack. What does that mean? Most investors spend their lives searching for winning stocks. They hire fund managers who promise to pick winners. They pay fees for this expertise. They trade constantly, chasing performance. And they lose, not to the market, to the costs. Bogle proved this with simple math. He calls it the relentless rules of humble arithmetic. Let's say the stock market returns 10% annually. That's your starting point. But you don't get to keep all 10%. Your mutual fund charges 2% in fees. Now you're down to 8%. You pay taxes on all that trading the fund manager does. There goes another 1%. You're at 7%. The fund's own trading costs eat up 0.5% more. Now you're at 6.5%. The market gave you 10%. You kept 6.5%. Wall Street pocketed the difference. Do this over 30 years and the damage is devastating. A $10,000 investment at 10% grows to $174,000. At 6.5%, just $66,000. You lost $108,000 to costs. Not to bad investing, to fees. Bogle looked at this and asked a radical question. What if we just eliminated the costs? That's how index funds were born. The index fund revolution. In 1975, Bogle created the first index fund for individual investors. Wall Street laughed. They called it un-American. They said it was designed for mediocrity. Bogle didn't care. He knew the math. An index fund doesn't try to beat the market. It becomes the market. It buys every stock in the index, the S&P 500, the total stock market, whatever you choose. No stock picking, no market timing, no expensive managers. Just own everything and hold forever. The costs? Basically zero. Vanguard's total stock market fund charges 0.04% annually, not 2%, not even 0.5%, 0.04%. Let's go back to that $10,000 investment. At 10% with minimal costs, you keep nearly all the market's return. After 30 years, you have $172,000 instead of $66,000. That's the power of not losing money to fees. But here's what really killed the skeptics, the performance data. Bogle tracked active mutual funds for decades. Over 15 years, 90% of actively managed funds underperformed the index. Over 30 years, 95% lost. The professionals couldn't beat the market, and even when they did, their fees wiped out any advantage. Warren Buffett saw this. He told investors to buy index funds. He even bet $1 million that an S&P 500 index fund would beat a collection of hedge funds over 10 years. He won, easily. The hedge funds had brilliant managers, sophisticated strategies, and they still lost to the simple index fund. Why active management fails. Bogle explains this with perfect clarity. Investing is a zero-sum game before costs. For every winner, there's a loser. If you beat the market, someone else underperforms. It all averages out. But after costs, it becomes a loser's game. Everyone pays fees, so the average investor must underperform by exactly the amount of costs. Think about it. All investors collectively own the market. We are the market. So collectively, we earn the market return. But after fees, we earn less than the market return. This isn't theory, it's arithmetic. Active fund managers make it worse. They trade constantly. Every trade has a cost. Bid-ask spreads, commissions, market impact. These invisible costs add up. Then there's taxes. Active funds generate capital gains every time they sell winners. You pay taxes on those gains. Index funds barely trade, so barely generate taxes. Bogle tracked this relentlessly. He found that the average actively managed fund trailed the market by about 2% annually, year after year, decade after decade. Some managers beat the market occasionally, but which ones will beat it next year? Nobody knows. And here's the killer. Past performance doesn't predict future results. The hot fund manager from last year usually cools off. Investors chase yesterday's winners and end up with tomorrow's losers. The data is brutal. If you can't predict which funds will win, and 90% of them lose anyway, why play that game? Just own the market. Capture your fair share. Stop trying to be special. The cost matters hypothesis. Bogle had a simple hypothesis. In investing, you get what you don't pay for. Lower costs equal higher returns. Not sometimes. Always. He proved this by sorting funds into cost groups. The cheapest funds outperformed the expensive funds. Every single time period, every asset class. It's the most reliable rule in investing. Here's why it matters more than you think. A 2% fee doesn't sound like much, but it's not 2% of your returns. It's 2% of your assets. Every year, whether the market goes up or down. If the market returns 7% and you pay 2%, you're giving up 29% of your returns. Not 2%, 29%. Over a lifetime, this compounds into millions of lost dollars. Bogle called it the tyranny of compounding costs. While your money compounds, so do your fees. The fund company gets richer while you stay poorer. The solution? Minimize costs ruthlessly. Buy the lowest cost index funds available. Vanguard, Fidelity, Schwab. They're all racing to zero fees now. Bogle started that race. Don't pay for advice you don't need. Don't pay for trading you don't want. Don't pay for performance you won't get. Keep your money. Let it compound for you, not for Wall Street. Time is your friend. Impulse is your enemy. Bogle had another famous line. Time is your friend. Impulse is your enemy. The stock market rewards patience, punishes impatience. Over one day, stocks are almost random. Over 1 year, still pretty random. Over 30 years, stocks win, almost always. Since 1926, stocks have returned about 10% annually. But that's only if you stayed invested. If you jumped in and out, chasing performance, avoiding crashes, you probably failed. Bogle showed that investor returns are consistently lower than fund returns. Same fund, different results. Why? Because investors buy high and sell low. They pour money in after the market soars. They panic and sell after it crashes. Their emotions destroy their returns. The index fund solves this psychologically. You're not picking stocks. You're not timing the market. You're just staying invested. No decisions to agonize over. No performance to chase. No fear of missing out. Just patience. Just time. Bogle invested through the 1973 to 74 crash, the 1987 crash, the 2000 dot-com bubble, the 2008 financial crisis. He never sold. He never panicked. He knew something crucial. The market always recovers. Not might recover. Always recovers. If you own the whole market and never sell, you capture the full return. The only way to lose is to sell at the bottom. Don't be your own worst enemy. Buy, hold, ignore the noise. The parable of the Gotrocks family. Bogle told a brilliant story to explain how investing works. Imagine the Gotrocks family. They own every stock in America, all of corporate America. They get all the dividends, all the growth, all the returns. Then one day, some family members get restless. They hire professional investors to help them beat the other family members. These professionals charge fees. More family members hire advisors, then traders, then hedge funds, then consultants. Soon, the family is paying billions in fees to themselves for nothing. The total returns haven't changed. Corporate America still produces the same profits. But after all the fees, the Gotrocks family is worse off. That's the entire investing industry in one parable. We collectively own the market. We collectively earn the market return, But we pay intermediaries to shuffle our shares around. Those intermediaries take their cut. We get what's left. The lesson? Fire the intermediaries. Be the Gotrocks family before they hired help. Own everything, pay nothing, keep all the returns. This is what index investing does. It returns control to you. It eliminates the parasites. It restores common sense, bonds, rebalancing, and staying the course. Bogle didn't just advocate for stock index funds. He built a complete strategy. Own stock index funds for growth. Own bond index funds for stability. Pick an allocation based on your age and risk tolerance. Young investors, maybe 80% stocks, 20% bonds. Older investors approaching retirement, maybe 50-50 or 40-60. Rebalance once a year. If stocks soar, sell some and buy bonds. If stocks crash, sell bonds and buy stocks. This forces you to buy low and sell high automatically. No emotions, no timing, just simple rules. And most importantly, stay the course. That was Bogle's mantra. Markets will crash, pundits will scream, fear will tempt you to sell. Don't, just don't. Every bear market in history has ended. Every crash has recovered. Every panic has given way to new highs. The investors who stayed invested got wealthy. The investors who jumped ship got left behind. Stay the course. John Bogle didn't just write a book. He launched a revolution. He proved that investing doesn't require genius. It requires discipline. You don't need to find the best stocks. You need to avoid the worst costs. You don't need to time the market. You need to give time to the market. You don't need complexity. You need common sense. Buy a low-cost index fund. Invest regularly. Rebalance annually. Stay the course for decades. That's it. That's the whole strategy. Wall Street won't like it. They can't charge fees on simplicity. But you'll like it when you check your balance in 30 years. Bogle spent his career fighting for investors. He created Vanguard as a mutual company owned by its fund shareholders. Every cost saving went back to investors, not to executives. He died in 2019. But his legacy lives forever in the trillions of dollars sitting in index funds. Money that's compounding for regular people instead of enriching Wall Street. The little book of common sense investing is his gift to you. Take it. Use it. Get wealthy slowly. That's common sense.
Take control of your future. Like, share, and subscribe to Financial Freedom.